90% of businesses are paying too much corporation tax. At least that's what we found over the last 5 years of working with UK businesses to help them pay less tax. In this video, I'm going to share 5 completely legal strategies that you can use in your business to reduce your tax bill. And these aren't loopholes or grey areas. These are things that HMRC allows you to do, but most businesses just aren't taking advantage of them. My name is Rayhan. I'm a chartered accountant and I run Sidekick Accounting. We're an agency specialist accounting firm helping people like you make more money and pay less tax. Now, before we dive into the specific tax strategies, let's talk about why paying less tax matters. When you're running an agency specifically, margins can feel tight and that can translate into constrained cash flow. Therefore, you need to look at your biggest expenses, and after team, that is often your tax bill. The difference between an agency paying a 19% effective rate of tax and a 15% effective rate of tax on £200,000 of profit is £8,000. That's money that could and should be left in your bank account available to you to pay yourself, to pay your team, or to invest in growth. Imagine nothing changes and you continue to overpay by £8,000 for the next 10 years. That's £80,000 that you've given away that would otherwise compound and exponentially grow if you had it available in the years before. So now let's talk about what you can do about it. The first strategy is to be strategic about when you're spending money. In the UK, most businesses will file their accounts on the accruals basis. That means that you recognize expenses when you incur them, not when you pay them. So if you're coming up to your end and you know you're going to end up buying a few new laptops and a camera in the next couple of months, you might choose to buy that equipment this year so it comes off your taxable profit, even if you're going to delay payment into next year. Now remember, you're only saving money if you are going to spend that money in the first place. So don't start spending money that you wouldn't otherwise just to reduce your taxable profit before year end. Strategy number 2 is to maximize tax credits. Tax credits are money that come back to you from HMRC, and they're different to a deduction, which is reducing your profit and therefore the amount of tax you pay. Now, a great example of a tax credit that agency owners miss out on consistently is R&D. Now, you might be thinking, we're an agency, we don't have scientists and lab coats. The R&D scheme is designed to reward you for innovation. And as an agency, you are constantly innovating and developing, building new systems for yourself and your clients, building new processes, designing new software. All of these things can fall into the scope of R&D and result in a claim back to you, which is a refund of tax money you've already paid or a reduction in your future tax bill. Another misconception that makes this tax credit so underclaimed is people think that their project or development needed to be successful. That's not true. If you spent money developing something and testing something and it failed, you can still be eligible for tax relief. So think about the projects where you and your team have really pushed boundaries in trying to solve a complicated problem. These could be super valuable R&D opportunities. Number 3 is to make sure you're paying yourself optimum. Don't just pay yourself a big salary because that attracts large taxes and national insurance. Instead, have a mix of salary and dividends that works for you. Now, for most directors, that looks like a salary up to the tax-free personal allowance of £12,570 and then dividends up to the basic rate limit of £50,270. With this setup, you end up paying just £3,300-ish in tax for the full year. Compare that to taking a full salary of £50,270, you'll end up paying around £12,000 of tax and national insurance. On the flip side, when you pay yourself dividends, they come out of post-tax profits. That means that you need to pay corporation tax within your limited company before you pay those dividends out. That can increase the amount of tax you pay, but in this scenario, for most company directors, you are still better off taking salary and dividends and paying some corporation tax rather than taking it as a full salary. The final thing to note that impacts this strategy is your business must be making a profit in order to pay a dividend. If you're not making a profit, dividends are illegal and instead you would have no choice but to declare a salary. And number 4 is pension contributions, specifically making employer pensions from your company into your personal pension. This is one of the most tax efficient ways to extract value from your business. Here's why: that contribution is tax deductible within the business. That means the money you put into your personal pension is actually also reducing the profits in your business that you're paying tax on. Second, there's no income tax or national insurance to pay on these contributions, so you're taking money out of the business into your personal name without paying any tax. And third, when you make that contribution, the government will top up your pension pot equivalent to the basic rate back. Now, everything that you make within that pension, whether that's capital appreciation, dividends, or other income, is all tax-free. So over time, you're compounding and growing your wealth in a tax-free environment for you to benefit from when you retire. As with everything, there is a downside to pensions, and that is once the money's in that pension pot, it's difficult or expensive to draw down on before retirement age. So the money is locked up for the long term. If you're looking for a shorter term investment or you're going to need that money in the near future, a pension is probably not the right vehicle for you. And strategy 5 is the strategic use of company assets. HMRC will let your company purchase assets, take a tax deduction, and then let you use those assets personally. The benefit to you is that you're not extracting that money, paying income tax, and then buying the asset for use. And a great example of this is an electric car. The reason electric cars are a great use of this perk right now is because benefit in kind rates on electric cars is super low. Let me go into benefit in kind for a second. This is a tax that HMRC will place on you for using that company asset for personal use. So if it's something that has a high benefit in kind tax rate, it's probably not worth you buying it through the business and then using it personally, because yes, you'll save tax within the company, but you'll end up paying a higher rate of tax personally. So certain assets are not worthwhile doing through the business. However, electric cars are, because the benefit in kind rate, i.e. the amount you need to pay to use that asset personally, is very low. Let's look at an electric car in a little bit more detail. When you buy that electric car, provided it's brand new, it's going to come off your company's taxable profits through what we call capital allowances. That means if you paid £50,000 for the car, you can take £50,000 off your profits in that first year. For you personally, there's benefit in kind tax that you need to pay. As I mentioned, this is 2% currently for electric cars, and it's increasing over the next few tax years. Regardless of the increases, it's still looking like for the next 3 to 4 years, it will be very tax efficient to have an electric car through the business. And finally, by having that company asset, in this case a car, the business can pay for all of the servicing, maintenance, installing a charging point, and anything else that comes with car ownership, instead of you having to take money out personally and then pay it. So personal use of company assets is a great strategy to help reduce the amount of money you need to take out, and therefore your personal tax bill, but also to reduce corporation tax. It's just important that you choose the right assets to use this strategy with, otherwise you might end up paying more tax overall. So there you have it. That's 5 legal strategies to reduce your tax bill as an agency owner. Now remember, tax planning isn't a one-size-fits-all approach. If you don't have a tax strategy, speak to your accountant or book a call with me and we can run through your situation and decide which of these strategies is appropriate and when you should be looking at implementing them. If you found this video helpful, give it a thumbs up and subscribe to this channel for more agency finance tips.